Your interest rate can drag your credit score down even if you never miss a payment. The score formula doesn't even use interest rates, and that's exactly why interest rates can wreck it. You've probably felt the squeeze already. Your credit card bill got heavier this year even though your spending barely changed. Maybe your rent jumped $200, your grocery run cost $40 more, and suddenly that card you used to clear with ease now refuses to budge. You pay again. The balance barely moves. Then your credit score slips by 40, 60, sometimes 100 points, and you're thinking, I didn't do anything wrong. Here's the part that hits home. The world changed around you, and your score reacted to the footprints you left, not to the interest rates themselves. Why does this matter right now? Because when interest rates rise, your debt gets stickier, lenders get jumpier, and algorithms get harsher. It shows up when your car loan quote jumps by $70 a month, when your landlord runs your credit and bumps your deposit, and when your insurance premium creeps up because you crossed an invisible score threshold. You feel punished for being the same person. The reason why is simpler than you think, and more important. Most people think credit scores only move when you miss a payment or open a new card. That's half the story. The other half is the environment turning small habits into big signals. And the moment rates rise or fall, the ground under your score tilts. So how do interest rates actually affect your credit score? Through a chain reaction that starts outside the score and ends smack in the middle of it. Here's the mechanism. Your credit card APR usually floats with something called the prime rate. When the Federal Reserve pushes the overnight rate up, banks lift the prime rate, and your card APR follows within a billing cycle. In the last rate cycle, card APRs jumped from the mid-teens to well over 20%. That means more of every payment goes to interest and less to principal. When less principal gets paid, your statement balance stays higher. Scoring models look at your utilization, the percent of your credit limit you're using, on the day the bank reports, which is often the statement closing date. High balance on that day, high utilization. High utilization, lower score. Picture this. You have a card with a $5,000 limit and a $2,000 balance. At 16% interest, about $27 of a $50 payment goes to interest at 24%. It's closer to 40. Pay the same $50, and at 16% your balance shrinks by roughly 23. At 24% it drops by around 10. That means the number the algorithm sees at the end of the month stays stubbornly high. Your utilization sits near 40% instead of drifting down. The score dings you every single month it sees that. But here's the twist. Your score can drop even if you pay in full. If you swipe aggressively all month and pay after the statement closes, the bank still reports a big balance. Rising rates don't change the formula, but they change your timing and your cash flow. And timing is everything in how utilization gets calculated. Now the second pressure point, lenders tighten. When money gets more expensive, banks take fewer chances. They run soft reviews. They lower credit limits or they close inactive cards. Nothing feels personal until your $10,000 limit becomes $6,000 with the same $4,000 balance. Yesterday you used 40%. Today you use 67%. It looks risky, even though nothing about you changed. Scores fall fast when a single card crosses 50% utilization, and they drop harder past 80%. Lenders call it risk management. Your score calls it a red flag. Wait, it gets stranger. Minimum payments increase when rates rise. If you set autopay to a fixed amount months ago, that fixed payment might no longer cover the new minimum. You think you're safe, the bank thinks you paid less than due. Twice in a row, and you're 30 days late. One 30-day late can slash a top-tier score by 90 to 100 points. Payment history is the heavyweight in every scoring model. Interest rates don't show up on the report, but the missed payment they cause does, and it hits like a hammer. Third pressure point, the refinance and promo trap when rates fall. Lower rates feel like a gift. You refinance the car, you jump on a 0% balance transfer, you consolidate. Smart moves, right? Often, yes. But scoring models see something else in the short term. A new account, a hard inquiry, a lower average age of accounts, and a closed installment loan that resets your installment utilization back up because the new loan balance sits near the original amount. It's not a deal breaker, but your score can dip even while your monthly payment drops. Lower rates can hurt you for a minute before helping you for years. And this is where things get interesting. Rates also change behavior around you. Landlords with floating rate loans hike rent to cover their costs. That $200 increase pushes you to put more expenses on a card. Groceries, gas, a surprise vet bill. Now your everyday spending mixes with a balance that's already sticky. By the time the statement hits, your utilization spikes. The score doesn't know your rent went up. It just sees the spike. Remember Maya, the bakery owner everyone in town loves? She ran on a small business line tied to Prime. As rates climbed, her monthly interest doubled. To cover a slow week, she used a personal card. Then the bank shaved her credit limit because her cash flow looked tighter. Her utilization shot from 30% to over 70%. She never missed a bill. Her score fell from the mid-700s to the mid-600s in 2 months. That drop made her vendor terms worse and forced a bigger security deposit on her lease renewal. Same person, different environment, different score. But here's what nobody tells you. Credit scores only measure a handful of things. Payment history, amounts owed relative to limits, length of history, new credit, and mix. Interest rates sneak in by reshaping your amounts owed and your consistency. The puppet master isn't the number on your APR, it's the cash flow stress that APR creates. So what do you do when numbers you can't control start pulling strings you can't see? You control the parts the algorithm sees. Start with timing. Scores look at balances that get reported, and most issuers report right after the statement closes. If rates have you carrying balances longer, pay once mid-cycle and once before the statement date. The goal isn't magic, just lower the snapshot the algorithm takes. Keep total utilization under 30% and under 10% if you want to look pristine. And avoid crossing 80% on any single card that line triggers sharper penalties. But there's a catch. If lenders start trimming limits, your best defense is to expand your available credit before they tighten the gates. When you're solid, on-time payments, stable income, ask for credit limit increases while your profile looks good. A larger cushion, cushion lowers your utilization without a dollar of extra cash. If one issuer says no, spreading spending across 2 or 3 cards keeps any one line from screaming red. Wait, it gets stranger again. Some banks balance chase. As your balance falls, they lower your limit so the utilization stays high. If you notice this, call them immediately and ask for a freeze on limit changes or a review based on updated income. If they refuse, move any recurring charges off that card so you never flirt with a late fee, and prioritize paying that balance below 50%, then below 30%. Those threshold drops often move your score in visible steps. What if you pay in full every month and still see dips? Your reporting snapshot is likely the culprit. Set an alert for your statement closing date. Pay a chunk 2 or 3 days before it closes. That one change can lift a score by dozens of points because the algorithm sees far less debt. It feels like cheating. It isn't. You're feeding the model what it asks for. Here's the part that changed everything for me. You can convert the type of debt the score hates into the type it tolerates. Revolving balances at high rates crush your utilization. A fixed-rate personal loan at a lower rate moves that same debt out of the utilization bucket and into an installment bucket, which the model weighs less harshly. Yes, you'll add a new account and an inquiry. Yes, your score might dip for a month or two. But your utilization can plunge from 60% to under 10 overnight, and your payment becomes predictable. Predictability is how you defeat rate shocks. Let's answer the question in the back of your mind. If rates fall, should you refinance your mortgage or auto loan, even if your score might dip from the new inquiry? If the savings are real, the slight score wobble is noise. Your credit score recovers as on-time payments stack up. But when rates rise, prioritize protecting your score from sudden hits. Lock in auto pay for at least the statement minimum plus a cushion. Schedule payments ahead of the closing date and build a 1-month buffer so a higher minimum doesn't trip a late. 30 days late is a cliff. Everything else is a slope. And remember the approvals game. Lenders tighten standards when rates rise. They're more likely to cut credit lines and less likely to approve you if your utilization looks high. The paradox is this: the best time to ask for more credit is when you don't need it. Do it early, while your profile still looks strong. Do not close old cards out of frustration. Age of account supports your score. And open limits lower your utilization even if you rarely use them. Put a small subscription on each older card and set it to auto pay to keep them active. This is happening to you right now, whether you notice it or not. Higher rates tell your balances to linger, your limits to shrink, and your minimums to creep up. The algorithm does not care about context. It cares about math. So you rewrite the math it sees. Here's how you turn this into control today. Map your statement dates and set 2 reminders per card, one midway through the cycle, one 3 days before closing. Aim to show less than 10% of your limit on each card when it reports. If a card's over 50%, attack it first until it drops below 50, then below 30 those thresholds unlock points. Call every issuer and request a limit increase before you need it. If you carry balances at high rates, consider a fixed-rate consolidation loan to move debt out of the revolving category, but keep the old cards open to preserve age and limit. If a balance transfer offer appears, take it only with a written payoff plan before the promo ends, because deferred interest can backfire, and set autopay to at least the minimum plus $20, so a new minimum doesn't surprise you into a late. You will feel the difference. Lower reported balances, stable payment history, and expanded limits create a score buffer that absorbs the market's noise. Suddenly, a rate hike does not shove your utilization over a cliff. Suddenly, a rent increase doesn't force your card to carry a $1,000 snapshot on reporting day. You aren't guessing anymore. You're steering. The hidden truth is this: interest rates don't appear anywhere in your credit score, but they show up in your behavior and your bank's behavior. Control those two, and you control the signal the algorithm reads. The world can raise or lower the cost of money. You decide what the model sees. That's the difference between feeling squeezed by the system and quietly making the system work for you.